Hey everyone, welcome to the weekly briefing. It's great to have you today, part of this conversation. We're going to have a kind of a big picture talk today. We're not going to get into weeds of the usual sales, production, finance, those things that we often cover. This is a conversation that you probably will consider one time in your career, maybe twice. You might exit a business twice, but this is a big conversation, something we're always working towards. And Tom has navigated this thing gracefully, I'd say, over the last few years. So I pulled Tom in here. Tom, thanks for being part of the conversation today.
Yeah, it's my pleasure. You're part of the reason I'm here. You got me here, or you helped get me here, so I appreciate it.
Yeah, my pleasure too. I say sometimes I talk to people about their finances or production, those things that we did originally with Hand Company. And I say, I like to get that out of the way so we can talk about the big conversation, this big exit. So it's fun that you and I have done that journey where I was able to do the smaller stuff or the operational stuff and then get to the merger acquisition conversation. So yeah, you're perfect case study for what I want to do more and more of for sure. Okay, let's introduce you to people so they kind of know who you are, what the company is and does. And then maybe like a setup a little bit of like why you were even considering a few years ago a need to do a merger.
Um, I started a company 26, 27 years ago, and navigated it through a whole lot of industry ups and downs and some growth. We added a digital group, a social group. We built out our offering across entertainment and lifestyle. And over the past, I'd say 8 years of that, um, I started to investigate what was next, right? And what that would look like. Um, when COVID hit, the industry, I think, was already changing. And I think we've all been on that roller coaster for 5, 6 years now. And I think those dynamics really drove me to try to make something happen at a certain point. Um, I reached out to Tim at that point, and we started talking. For me, it's a mature company, and the struggle was real. Like all of the different dynamics, all of the ebbs and flows of the industry, the COVID employees and their individual struggle affecting our business, the strikes in lifestyle during COVID, hospitality, which is a part of our business, just went away completely. And so how do you rebuild that? We had our core customers and we had good relationships, but budgets started shrinking. All of the things seemed to be just stacked against us. And so really having to gain some perspective in that because I was getting lost in the weeds.
Yeah.
And so understanding what was out there, understanding the dynamics, that was really helpful for me. And then backing up off of being reactive to pursuing things that, made me successful in growing the business. And shifting that mindset a little bit was really important. So,
Do you mean, can you speak to the thought of like the industry has its own curves, right?
mhm.
And so to some degree, like you probably in 26 years rode a couple of those curves, then there was a recovery and rewrote those curves. But then it feels like, right, that also at 26 years, there's a one gigantic curve of just your life and biology and interest and whatever. And to some degree, it feels like the two things lined up. Oh, wait, 20 something years of doing this and have to fight another curve and build up. You wanted to do something different. You want to do it differently than just like Tom bootstrapping it like you
Mhm.
did when you started the business, but something like, hey, it is a mature business. There's assets. Could we leverage this forward? Like, do you like that? That kind of is what the transition felt like, at least from my side.
Yeah, and I think the waves were different too, right? Because like I felt closer to the shore, right? I've been around for a while, but the waves got closer and closer together, and that created this circumstance where this do it all yourself approach was really limiting and really constraining. And there's a real struggle in that. So, I got to this point in my career where I wanted to do less, focus on the things that I think I did well, and then put a lot of the other stuff down. And that really led to reconsidering what my business is and what my part in it is, giving pieces of it away in order to be able to enjoy it and to thrive in it myself personally. So,
Yeah. Give it away, and you gave up a few things. I mean, you had a
mhm.
gorgeous space right across on Sunset Boulevard, right across from Chateau Marmont, right? That was like same neighborhood. And then you had a great roster of employees, a huge track record, and even some in-house services that you were doing some finishing work for major studios. And in this consideration, you really had to think of like, well, what stays and what leaves, right? Like, do you need the building in order to continue? And I know that was one of the big shifts to just walk away from the building. But also employees or strategically what you thought would go through, continue and what wouldn't. And I think digital might have been, or social was one of the things that you kind of realized wasn't worth the service to keep that going.
Yeah, and those are the hard decisions, right? And I think that's where you have to dive in and be really honest with what's important. And not just what's important to you, but understanding that some of the things that are important to you, you have to let go of. And people, I think it drives everything that we do, our entire business. And so when you have good people, those become really hard decisions. But there is a balancing point where I felt like I was constantly taking care of all of the things and trying to keep the pieces close when in order to do that, I had to let some of those things go. And so we closed down our social team, and they had been up and running for, I'd say, close to 6 years, maybe more at that point. And there were some big successes. It's a good group of people, very smart people, but I think that ultimately we were misaligned. The industry at that time, from a budget perspective, from a project perspective, wasn't being kind to social, at least in my experience. We'd run through a time in which social was booming. We had some great opportunities. We got some AORs. And then when we got to project, and it became harder and harder to hunt for those projects, the business didn't work.
You were also in a very competitive field. You were doing entertainment marketing. So I know that you worked
Mhm.
on some of the more premier entertainment brands, shows, and so on. You also had like a second department in a way, or a separate um, discipline when it came to lifestyle and lifestyle brands. Um, and I know there was somewhat of a challenge between like, hey, which of those assets or what's important for those assets that will convert universally, or how you bring those forward into a different relationship with a potential business partner or merger or something like that.
Yeah, and I think part of me got lucky. We've been through the merger process or the process of investigating partners a couple times. And this opportunity was with somebody that I knew and I trusted. She had actually worked for a company years prior. And so we had a really strong relationship and we had a complementary leadership dynamic and complementary skills. So we were able to go through the list of things that may translate, whether it's people, types of projects, clients, systems, and just line up the things that and then in which there was overlap. And that was really helpful because it made it so much easier. I think we took like a probably a year-long shortcut in the assessment and the integration of our companies.
Yeah, I mean, we have this thing called the core group, and the core group is really six, 7 business owners are together. We're kind of living it out together. And I started that in mind. Just you're the ones that kind of kicked it off for me, Tom. Like to get a group of people at the same stage, thinking about the same stuff. I swear, my thought was it would take a whole year before anyone would be successful, and we got like halfway through the year, and you were already done. You had merged and kind of jumped right into the new relationship. That felt like a very quick turnaround. But I know prior to that, even though it might have been quick in the conversation with WC+A, you had other conversations and knew what was right and what wasn't going to be a good fit for you. What in that decision making or in that process, how did you know what wasn't going to be good? What did you kind of know to reject right away, or after you did some homework to realize it's probably not the right strategy for you moving forward?
Yeah, there were a couple. There was a production company that was looking to extend its TV production and content production services into a marketing uh, element and package that up and sell to distributors. Um, Loosely, I don't think the business quite made sense to any of us. We kept trying to figure out how it would work, and ultimately, their strategic business leader left the company, and they had to refocus specifically on production services. So that was maybe a timing thing, but like philosophically, conceptually, it didn't quite work. There was another company that was a bigger agency that was building pieces and parts and creating their own ecosystem. And that was a matter of personal alignment, right? You get a sense for people, their ecosystem. It made sense on paper. The thinking behind it made sense, but the clarity of how it would work, how it would function, what role we would play, what value we would get out of it, those are the hard questions I started to ask myself. It's nice when people say, "Hey, here's, the potential of this much money, here's back end ownership, here's all of these things," but then, to unpack it, to slow down and to analyze really what it is was really important for me. And it just becomes very clear that you can't rush into a financial decision, however exciting and sexy it feels, if
Yeah.
it's not right. Like ultimately, we made this decision based on, you know, opportunity and fit and personal trust, the people, complementary styles, complementary philosophies, and complementary services. And the financials, in a weird way, take care of themselves. They're less important. I know they're very important, when you
Yeah.
want stability and security in the business. But if that is in place, then you can go out and build around that. So,
Yeah, right. The finance side is really important, but it's also really obvious. Like you can't
mhm,
change that. You can't work backwards and fix something from years ago. So it's the first thing, it's the thing you're constantly talking about, but it also doesn't move very much. It is all the other kind of pieces that make a
mhm,
difference. I remember one lunch, it was you and me and one of your like direct competitors that the two of you guys were talking about merging. And that didn't work out either. But I know, between the two of you, there was just a comfort of like, wouldn't it be great just to have somebody else to talk to that's in the same business that I'm in, and maybe our chemistry can keep it going. But even that, what seems to be a very obvious connection, almost a friendship between you guys, easily. But the thought of like, but you actually didn't expand anything. There's no additional future. You're just taking over more of the same pie. There's not another pie to go after. And this one, it was like, oh, you do something different than we do, but our philosophies line up, our respect lines up, our trust lines up. So we can each go for something. And then that's where the one and one could equal three, because there's an additional element if we do this well.
yeah, a couple points there. Like I wanted an opportunity that opened up new business for us, and we were competing factors. We've worked together for years. He's a good friend, high respect, great creative, but at the same point, we'd be cannibalizing each other, and the growth was less apparent. We were uh, different in ways, but too similar. And then the financial equation didn't make a lot of sense either at the end of the day. So with that, you take that and you look at the other opportunity, and because WC+A did something different, they're creative services and production services. We're branding, we're creative strategy, we're creative across a wealth of different disciplines. And so we could layer that on top of them, build out with our clients and offer the production services and the support for um, manifesting the campaign throughout. And then we could take their clients and say, hey, we're going to offer strategy, we're going to offer branding, we're going to offer creative campaign fulfillment and the development of these things. And that's why it's worked. We've been able to build from both sides. And so it made sense at the time in theory, but in practice, it makes even more sense.
Yeah, right. Some people refer to that as land and expand. I could jump into your client base, add my services to it, and
Mhm.
expand it. you can come over on my side to expand the same way. If the companies are too alike, you're just landing, but there's no expanding because it's the same. We would just like we wouldn't add anything to each other. And even the total revenue would not necessarily go beyond the total. Usually it becomes 80-90% of what the combined revenue would have been. So
Yeah.
probably nice to go to work every day with somebody that's a friend, but not necessarily the best business decision if it's too closely related.
You also mentioned, that this person and I, we could share and commiserate and share stories. And then you mentioned the core group earlier. That's the value of the core group, right? It's like a sanity check. Really talented, really smart people, business owners. And when we started to regularly meet, you could bounce things off of each other. You can have a testing point. You can vent. You can strategize. You can pose a question and get an answer. And like there's an understanding of the industry that happens, and then an understanding that you're not alone and that solutions are out there. And I think that was really just helpful from a personal perspective for me, because sometimes as a business owner, you just feel like you're it.
Yeah, right. Yeah, that's why I love that core group because I felt like I put strangers together, but you guys really attached quickly
Mhm.
because of the stage of life that you're in and just needing to be open with somebody.
Yeah.
And it has to be another business owner. It has to be someone that's in a similar situation so they can quickly relate to you. But then also something to kind of like compare. So I think of like when we all did valuations, there was almost like shock across the entire group when they got their valuations back of how the revenue multiplier really works and where the money is actually made and what was is missing for a lot of business owners or what might be missing in different businesses to compare that to learn from each other and to complain at some point with each other like whoa this is harder or this isn't quite what we thought it was.
Yeah.
That group is at least somebody you talk to. Otherwise, you're just throwing your shoe against the wall by yourself because there's no one else to process with. Um,
Yeah.
yeah, that's it. Those are great groups, and you have a really kind of core group there. I don't think you guys are ever going to break up. You guys,
I hope not.
yeah, I
A lot
don't
of
think
fun.
so. Okay, so tell me what you did was an acquisition, right? They acquired and company, not a merger. Um,
It was a merge.
oh, it was a merger. Okay, great.
So yeah.
So in the merger part of it then, is there really clear of what things have to be let go of each side? Hey, if I'm bringing financial services and you have a finance team, we only need one of them. So you kind of figure out where to kind of carve out different departments and people along the way.
Yeah, very quickly. I think that's it. That was in the preliminary talks. Actually, it wasn't even in the details of agreeing to it and moving through. It's I think it was two businesses and two people who were running businesses, understanding how they can streamline and how they can grow at the same time. Be as efficient as possible. I let go of all of my operations team, my finance team, because that is what she does. And she does it extremely well. She's got a team that, knows exactly what they're doing. They have systems and processes that provide good profitability measures and ensure that or bake that in as much as humanly possible. And from a creative perspective, it was my creative team that came in. We led the charge. And then we added an executive from Disney, an executive from Amazon to rebuild around the new opportunities and to lead us even further.
Yes, some of those Instagram posts or LinkedIn posts of your new acquirers, it's I can tell you it's created some waves and some conversations. So I gotta
Yeah.
talk more
Good.
about that. That's fun. Okay, so just to maybe school a little bit, but the difference between an acquisition and a merger, at least the way I would think of it, an acquisition is when somebody is actually there might be a cash component or stock component of it, but they're buying your business. You could acquire just the assets alone of a business. So that could be your contracts, your
Mhm.
employee contracts, your accounts receivable, your accounts payable. Well, you can just take those elements and leave the corporation alone. Or there's another thing called a stock acquisition where you just buy the whole business, warts and all, bring it all in there and buy it all. So the acquiring team would kind of figure that out. When it comes to a merger, there's often not a swap like that. There's not a purchase necessarily, but there's a measure of the value, and then combined together, you would keep a portion or have a percentage portion of that value. They would have a percentage portion, and you're kind of looking at maybe a next exit as a company to a third party, and that's where you would cash in. Combined, in your evaluation, most likely was more valuable than you as separate. So you can connect together, make the operations work, sell off that unit. Um, you don't have to tell me all the answers, but to some degree, I think that's probably what was weighing into the right team and the right combination
Mhm.
of merger versus acquisition.
Right. And so we did that, right? And then I licensed different other outside components of and company to them. And then part of this was not just doing this and being done, right? It's future planning. So we have a plan and a map for where we want to be in 3 years and what that includes. So from moment one, we were all moving in that direction. And that's why we're adding additional pieces. That's why we're able to say, this is the start of something. And we have our own personal plans and our own business plans wrapped up in one overarching direction and vision. So it's helpful that way.
It's interesting. The pattern I often see with businesses as they go through this process is the first connection they have with another outside business is a merger. It's usually because there's not enough cash in either side of the equation to make that happen. And as an individual business, they're not worth enough to go get outside capital to give it to them so they can acquire somebody. So they find somebody like you that's closely aligned and they can put that party together. And now they might have a valuable enough business that they could go to private equity and get money or generate enough revenue themselves. And then future additions would be through acquisition and not mergers. That way, you don't dilute the ownership into tons and tons of owners. You kind of keep a core group and grow that way. So it's not uncommon. The first step looking at is an acquisition. But as you said, like who that person is and knowing there's a future component to it. So you guys attached and you immediately started that journey for
Mhm.
that future. You weren't guessing. You almost needed to know. You probably were moving it along before the acquisition took place. Or I'm sorry, the merger took place, so that you knew that you can just can meet each other and keep the momentum going.
Right.
Otherwise, you would just be wasting time.
Yeah.
Um,
I mean, the integration isn't easy, right? It's you have to pay a lot of attention to a lot of things. You're navigating people, right? You have to focus on new risks. You have to, like, there's a client reframing. We haven't yet rebranded, right? And that's in the process. We just came up with a name. We're vetting it through legal, and we've got this process entirely ahead of us. But rebuilding creative teams, working through, you think that all these people will fit and we can make it work. And then there's always a dynamic that doesn't, right? And so you have to address that. Culture is a big component. There's fear in all of this for, the employees that I brought over and the employees they have. And some people will leave and some people will come. And so you have to be extremely flexible in this. Your best laid plans are only that, right?
yeah,
They're
sure.
outlines. So,
So tell me more. By the way, I'm glad you're rebranding because even asking, trying to figure out what to put as the company for their little thing, it's
mhm.
a WC plus sign A and percent C. Like there's just so many, you have to
It's a
kind
lot.
of
Yeah.
get around to that. And that's a little bit of a humbling moment too, of like you've lived with this brand for 26 years and then you have to find a new word to replace the overall feeling. It is kind of it's a process in and of itself, isn't it?
Yeah. Yeah, I'm looking forward to putting it down, but I think that we kept the stories to the people that we know of what this was all about. And then when we go through a rebrand, then we can announce this story in a broader perspective and come away clean with a fresh start. And after 26 years of building and running a company, it's exciting. It's exciting to do something that feels new.
So when you were thinking about the merger, which was your greater concern? What your employees were going to think about it or what your clients were going to think about it?
Equally important, right? I think
I,
you secure the people closest to you as quickly as you can, right? And so having conversations before this was even formalized, What do you think about this? Here's what I'm considering. Here's what I see as the potential. Here's the opportunity. Here's where I want to go with this. What are you looking for in your career? What do you want? Inviting people into that conversation and making sure that you're truly considering them as opposed to using them as commodities to trade. With the clients, you really can't go out there until you can go out there until it's done.
Yeah.
So setting up those over the next couple months and explaining them within the context of the work and the work that we're doing was really helpful because there was if you've got a 6-month project, you've got a cushion on multiple sides so you can manage that transition eventually with the different client groups. So.
How'd that work out with clients? Did you run into any roadblocks, lose anything, gain anything? Like, did they immediately say, "Oh, good, because I was going to give you a lot more money if you did add that service"?
Yeah, a lot more money from clients these days. I don't think that
Sure.
that's the conversation. We didn't lose any clients. We actually built, right? Some of them were nervous. Some of them didn't understand, what that meant if they were going to get the same service, if they were going to get the same creative, the same team, and there's some skepticism in it. And we were given opportunities, and we threw everything at it in order to ensure that we were delivering more. I've always thought that you deliver more than the client asks always. That's why we're all in business. But we kind of ramped that up and brought things to bear, and a lot of new opportunities came from it. We took a Disney project for Fantastic Four, which was just a small little project, and turned it into 7 or 8 different executions over a 5-month period because um, we were all in.
Yeah, nice. So your services almost have a longer tail. You can start the
Mhm.
conversation anywhere with any client and then try to find more services and more strategy you can attach to it as it plays itself out.
Right.
That's amazing. That's great. Did is there any like there were any legal hangups? I know that I've been in conversation with some business owners and their thought process of telling their client and signing a new MSA, and they're like, "Oh, I don't know if I want to have to go through that whole process." They're almost afraid of like they're creating kind of resistance, and the client would go, "Well, that's too complicated. I'll just go find somebody else." Um, I don't
We
know if
manage
that's
that by and companies still around, right? And so the and company clients, some of them have gradually changed over, and we've had an on-ramp to be able to do that. But we can still do business from and company and from WC+A's side. And so we took this entire year purposefully to manage that and to move through the annual renewal of MSAs and retainers and all of that process and have to be able to deal with a lot of those things. There have been some headaches, right? What is it? Coupa and the right address in the right place at the right time with the right assignee, all of those things. But again, those are minor in relation to what we've tried to pull off.
yeah, sure. Sure. So then what next? Like, what are the wins in this thing that you're seeing already? And what would you encourage people to lean into if they're considering this?
Yeah, I think the wins for me, like I can speak from my perspective, it was being able to do the things that I felt like I was good at and not having to do the things that I was struggling with, right? A little bit of a focus. I can focus on what's ahead, be strategic, build a business and build teams, dive into the creative where I'm valuable, and when I'm valuable, and the strategy at the same point. From a company perspective, I think we were an older company. We needed a new story. We needed new opportunities, and we've been able to build new clients based on it. We were able to work with Samsung uh, off of production services and start doing branding and creative and motion and rollout along along a different trajectory. So those are the wins. And they all, trying to make sure the wins align with where we want to go in the future. And that's building something that becomes a multiple of success.
Yeah. please take this as a compliment, but you just seem like your load is lighter than it
Oh
was.
God, I can't tell you. You saw me, like, it's hard,
Yeah,
especially in the throes of 23 and 24. And, those are not easy years, I don't think, for anybody. I haven't, met anybody where you bring that up and they smile about it. So,
yeah. There it just I remember the first conversations, there was a lot of fog because it's like
mhm.
something had to be done. You have to make progress, but it was hard to assess the risk, what the reward would be, where the direction would be. There was just so many vague things because nothing was coming at you immediately. Nothing was obvious, but you kind of also knew like you're not gonna you could be in business for 2 more years
Yeah.
because you'll just wrap this thing up, or you can do it for 15 more years if you found the right partner. So to lean in with a little bit of faith and a little and that kind of core group, a little bit of community that can kind of keep you going and then
Yeah.
help you find that way was really sweet. Um,
Yeah, the uncertainty component, right? Like that was, palpable. It's still there. It's still, very much a part of our business. Nobody really knows, where we're going. But I think having a new plan and a new path for it, that makes it easier and lighter.
yeah,
Right? Like,
sure.
we're actively doing something. I don't feel like I'm just caught in the reaction of it all.
Okay, I've hogged all the questions, and I just want to make sure if anyone else had a question, they could just raise their hand and pop in here and ask anything too. But I'll say Tom won't bite, and he's really honest, so you can probably ask him anything. He'll give you the answer to it if you're curious. We don't have to, but
Hey, Tom. Hey, Tim.
who's that?
Jason.
Oh,
Semelka.
hey Jay,
Hey, Jason, how's
it's
it
good to
going?
see you.
Good to see both of you. I missed the top, so I did not hear how the structure was created for, like, are you I heard that it was a merger. Are you then a percentage owner of the new entity, or how is it set up?
Yeah, it's a strange deal, and I'm a consulting CMO, right? I have a stake in the company. I have incentives as the company grows. I also have the freedom on the back end to do other things. So I opened up my own side company, and I'm doing projects for people like NBC and things that don't overlap with the business. So one of my goals in this whole merger was a little bit more flexibility and the ability to expand and do some things kind of grow outside of what I have been for a long period of time. And so managing that in that negotiation was really important to me. But I'm still, I still have my commitments to them and responsibilities to them first and foremost.
So it sounds like traditional elements of like your an employment package for you is
Mhm.
part of the merger, so it's clear what your responsibilities would be after, what your company's assets were that they're taking on and how
Mhm.
that's supposed to convert to value for them. If it converts to that value, you'll get a payout and get rewarded for it. So you are incentivized to make sure that that is successful. But there are elements that you know you could be personally successful with that they didn't care to have attached to that business and have some independence from that also. Those are some
Right.
really great um, deal points for you.
And additional growth incentives, regularly. So there's the ability to have a baseline to take part in the short-term successes, but to take a bigger part in the longer-term success.
And it sounds like the deal is playing off both your strengths, your marketing expertise, their financial and production expertise. So
Mhm.
you could let go of things that you didn't necessarily weren't in your genius category. You could say, "Oh, thank goodness you guys are here. You can do that part. I'll just lean into the stuff I do at best, and you both win." That's really awesome. Any other questions, Jay? I know I kind of grabbed the microphone for you for a second, but it's good to see you. We'll see you soon. Any other thoughts, questions? You guys are hanging on, so I know there's something else you might want to know or want me to ask.
Tom just makes it all seem deceptively simple, and he's so calm about it. It's hard to know what to ask.
Yeah.
What were the hardest bits? Tom?
Uh, Getting my mind around it, right? Like it's simple because I spent 3 or 4 years agonizing over it, to be truthful, and going through all of the struggles and the back and forth and, being stubborn, being proud, having ego, all of those things, and then being like thinking that it's going to get better magically somehow. And I think the hardest part about it was coming to terms with all of that. Understanding that I did need to do something different instead of, because I've been doing that same thing in different ways for 25 years and it's always worked. And then suddenly I just didn't feel like it was working. It definitely wasn't working for me. And then the hardest part about it was the employee and the personal relationships. I think, part of me had to get over what people may think and what conclusions other people may draw, and then kind of own that myself. So
Wow, a journey.
Matt can relate to you. Matt, you sold your business, but yours was an acquisition, and to some degree, yours had a finite end to it. You had an earn out period, and then kind of the deal was done, right? I guess you could have stayed on, and you were also purchased by a large conglomerate, Deloitte, opposed to just merging with somebody that is on the more friendly side. So there, but you relate to that, like, hey, it's time to transition my business and think differently and kind of find out where the pieces might lie.
Yeah, I mean, a lot of my decision was actually based on a lease, like a 10-year lease ending. So I was like, I knew that something had to change at this point because I had to move to a different building. And I actually have heard retrospectively that a lot of businesses make decisions based on leases. So it's good to actually recognize something in yourself that needs to change, except a location, to make that decision.
Was your lease was up too, Tom? I'm wondering if they're how
we
relatable that
were
was.
indefinitely month to month.
Oh,
So
definitely. Okay,
I had a great
yeah.
relationship with our landlord and very fortunate because he was very flexible during COVID and the recovery from it. So could
Mm.
have stayed there forever. Really didn't want to anymore.
Oh, really?
Yeah, I mean, you get to a point where it's just like it feels like a jail that you've built around yourself, or
Hmm.
a golden cage.
Yeah,
Um,
depending on the light, right? Golden
yeah.
or, steel, iron bars. So,
Right,
Um,
right. Oh, you're catching that shine off there. Any other questions or thoughts? Feel free to kind of jump in. Be happy
I have
to
a, I have a quick one,
hit them.
really quick one. Sorry, Ben, jumped
Go ahead,
over you.
Ollie.
Hi Tom, how's it going? Um, yeah, just a bit of advice for new business owners. Like, would there be anything you'd do different, in your younger self?
I think it's good that you don't know what you don't know, right? I think that lets you take the risks that you need to take. Business is creative and just going for it and doing all of those things. Like, I think if the structure, the profitability, all those things tend to get in the way when we overthink those things, then I got bogged down in them, and it affects, what we do so well. So it's just a matter of keeping it as lean as humanly possible, I think is the new mode of operation. And spending energy, effort, focus, and money in the right directions that really support what you're in business for.
Yeah.
Brilliant. Thanks so much. Appreciate it.
Mhm.
I mean, thanks, Ollie. The beauty of being in a creative environment is that you can solve the problem creatively often. But then all these things in business start attaching themselves to you. Things that are not creative, they're overhead, they're overarching. And I like how you said earlier, like they're sometimes attached to ego, where like the name and the brand feels like it has to stay around because you work so hard. And what would other people think if you had to close it? Those are heavier weights than just being a creative person doing something creative. So it's real. Ben, do you want me to bring you in here?
Sure. Hi. Sorry, I
Yeah.
missed the first half. And this is like my partner and I going like, oh my God, we got to go to this. I want to hear what Tom has to say. So apologies if I'm rehashing anything, although Matt has assured me there's probably an interest in going further down the pipe on this. I'll give you some context. So we're a small two-person shop up in Canada. And our business is built around a network of suppliers and service providers who are able to help us kind of scale up to the need of a client. And we work across dimensions that are probably very familiar what you guys do, but at a much smaller scale. Out of nowhere over the past 2 months, we've had two larger agencies come kind of circling around us, talking about we're looking to acquire to gain resource and access to your market. You guys are, there's like interesting conversations that I'm approaching with a very kind of high level of trepidation, largely because it happened to me in the past and it was a giant disaster. And I was 20 years younger and I've learned a lot to be wary of things that look, wary of Greeks bearing horses, right? So, but one of them we're starting to evaluate and go, well, I see the value proposition from their perspective of what they're trying to do. This isn't about them trying to flex. They are a French company looking to get a better foothold in English-speaking North America. They're based out of Quebec, our French-speaking province. We work a similar scale of businesses. And we've talked to them about, why don't you just hire people like us? And they said, well, we don't want to hire a creative director. We want to hire people who understand and can turn the business on for us where you are. And anyway, so we're going down the path. And my question that was in the chat, maybe talked about, but maybe expand on is, if this becomes more realistic, we're like, we started this agency 8 years ago. I've been in agencies before. I've known people who've sold agencies before and been acquired. I don't understand how valuation works. My understanding originally was you buy a larger agency for the client roster, for the resource capacity that you're probably going to hope will stay once they get bought, maybe the name that goes along with it. And I'm guessing those things are all probably valid components, but I'm curious, like, how do you evaluate any of that? Especially when you're in our position where we're so small. And hopefully I'm not looking for an answer as much as just an understanding of what does that thought process generally look like? Or are there fundamentals that go into that thought process that get applied in different situations that you're aware of?
Do you want to take that, Tom?
My point of view is, it's the people. Like, you have a unique set of skills. You've built businesses, you've managed businesses, you have a service that you provide. So you have expertise, but you also have business and people skills that are really hard to come by. So they could hire people, but you don't know what you're getting. You've done it. And so the hard part for me was putting a number on some of that stuff, right? And in our conversations, one of the reasons we ended up in merging is it's hard to quantify some of the things and the skills that each of us brings. They would be acquiring us in my instance, but it didn't speak for me and my value. It didn't speak for some of my key employees' value. And one of the things that I wanted to do was have my key employees negotiate their own packages so that there was a potential for them to explain their worth, define their worth, and then work under that understanding. And the same with me. I think, in your instance, like, yeah, you can go to, this is your revenue, this is your EBITDA, this is that, but it shortchanges the creative entrepreneur in such a great way.
Mm-hmm. I appreciate that, Tom.
I'll tell you. So Ben, I'll tell you one thing that you're often trying to build as a business is more and more of a unicorn, right? So the more unique the services you provide, the more unique your profit margins are, the more unique your revenue generation is. So that's why I like higher revenue businesses or higher profit businesses get more, because it's harder to do that. It's really common to make 5% profit. It's really hard to make 25% profit. And so your valuation is often based off of those unicorn features. What's interesting to me is how often creative business owners want to sell their brand. Hey, this is a 26-year-old brand. It's got to be worth $3 million because I feel like it is. But then the acquiring party or the merging party says, well, can you prove it? Can you prove that brand has any value? Because the value it seems to have in the marketplace shows up on the P&L, right? Like, if it had that value, why aren't you getting that value out of it? Why would it be different if I bought it, right, as a person? So that's why people look at that, your P&L 3-year, 5-year look back to see what that brand really does mean in the marketplace, what clients attach themselves to that brand. And so they will use a valuation of your profit and profit margins. Here's the trick. This is what I think most people don't calculate into it. there's a term called a multiplier. So the more unicorn you are, the greater that multiplier is. So let's say you made $1 million in profit and you had a 2 times multiplier, your company's worth $2 million. But if you make the same $1 million in profit and you're more of a unicorn than anybody else, and you get an 8 times multiplier, that same $1 million in profit becomes worth 8 million instead of 2 million. So that multiplier piece of it is what you're often negotiating more than you're negotiating all the other pieces. And the element there is how fast I could generate new money from your business. If I can generate it faster, the multiplier goes up. So if I could double your revenue in 1 year, I'll give you 10 times the revenue, or I'm sorry, the profit. If it takes me 20 years to do it, I'll give you 1/2 percentage of your revenue because I have to do all the work and you're not doing any of the work. So there's kind of an element there, a key element there that we have to think about. It's affecting that multiplier, and that multiplier is affected by, I'll call it again, the unicorn factors, how well you've done on your own profit margins, how well on a project by project basis, how well you've generated new revenue, the type of clients you have, and sometimes the people or services that you provide. So like in Tom's case, his social department didn't have any value to the new business, even though might have had value to somebody else. It wasn't worth anything. So you kind of doesn't have a value prop in it. That's why that might fall away in that deal. Go ahead, Ben.
My classic
Yeah.
follow-up.
Yeah.
I get that actually really helpful. So those are tangibles, right? Those are things where I can say, look at my history, look what I've done. And I can look at the books. We can say, great, your profit margin's X, your market potential is Y. I think the challenge I'm facing, and again, maybe this isn't something we answer here, and maybe I just kind of go into Matt's time zone and chat with him, is what about potential? I mean, I'm sure there's ways to define potential. So I'm sorry if I'm using my case here specifically, but I'm curious about, like, are there mechanisms for defining, hey, you can't access this market without us, but if you could 10x your footprint. Are those things that are common practice in terms of definition? Again, it's like, Tom, is this anything that was ever discussed? Or does it typically come down to show us the books, right? Let's see what you guys look like on paper. I don't care about what's possible. I want to know what's happened.
For me, the potential defined the back end stake.
The back end.
Right. And
Right, okay.
that's where we could negotiate potential as opposed to the practical initial transactional component.
Yeah. So that there might be a trail, 2 years, 3 years, 5 years, that you could make money off of your business as it's attached to a new business. That's called the back end. So if you believe that there's more potential, you can basically take the risk, take less money or no money up front, take it all in a percentage later on, influence this combined business and make the combined business worth more than the individual parts. That would be a back end deal. The valuation is often done on the front end or the transaction moment. That's where the valuations lie. So I had this weird moment when I was buying this house. There's a property nearby. It was a blank piece of property. There was nothing on it, but it was priced as if there was a house on it. And I asked the realtor, why is this piece of land so much? And the person who's selling it said, well, I have plans drawn up for the house that you could build. I'm thinking, yeah, but I would have to spend $300,000 to build the house worth $400,000 when it gets like that. Doesn't make any sense because the potential is mine. Like I should get the upside if I build a house. Just because you could build a house on a piece of land doesn't make that land worth more than the land itself. Businesses work the same way. So that back end allows you to take the risk, but your valuation will be on what the immediate transaction is, and then what the value of your business is currently to the value of the other business will determine what that percentage might be. So Tom, that's what you did, right? They had a valuation, you had a valuation, you were a certain percentage of the whole, they're a percentage of the whole. And then that way those splits carry on into future deals, profit sharing and so on.
There was an initial stake. And then what I did is I built kickers based on performance. And then those kickers also activated a larger back end as well, just to try to tier different ways to realize, all that I'd put into the business and who I am and the value that I think I bring. So
Yeah, and that's a great win-win, especially when she could say, Tom, I'm going to take some of these operational elements away. I will incentivize you to do this thing you're really great at. And if it grows greater than our expectations, I'll reward you more. Those are kind of like a win-win proposition for a merger. So that's really awesome. Those are great questions, Ben. Thank you.
I have more.
Oh, yeah.
Let people talk first.
If someone else wants to, this is Ben, by the way. You have to raise your hand if you want to cut Ben off. I know. Do you want to ask one more? I don't, Tom, you have 7 more minutes. We can kind of finish at the top of the hour. Is that okay with you?
sure.
Okay.
I did see Robert's hand going up, or he was just making the mistake of raising
Robert, do you
his hand
want
at
to
auction.
jump in?
No. Ben, keep it going.
Okay.
Okay. Okay, so the next question then, and maybe again, sorry if you've already covered this, and if not, maybe you can expand on it, is my previous experience was I made a choice to to kind of jump into bed with another company that didn't work because I misinterpreted the opportunity, but I also misinterpreted the relationship, but I also misinterpreted the potential opportunity that I had I not gone in. And so as we're looking at these sorts of conversations, and not to go deep into the weeds, but the reason I'm a part of RevThink is Tim's been helping us figure out our sales strategy because I feel like we are under indexing our ability vastly. And so I'm learning sales because it's like, hey, we're really good at what we do. Just got to get in the room. And I don't know how to get in the room. So I've been working with the group here to help figure that out. And I'm actually seeing some lift, which has been great. Thank you, Tim and Matt, and Jason, whoever he is. So part of the challenge I look at is this is not a large agency. This is I would say like a 10x in terms of the size of us. So it's still quite big relative to us. But I mean, we're 2 people. So it's like 20 people. It's not a giant thing. And so I look at this and I started asking myself the question, is this, I'm trying to evaluate if we did what we thought we would do, which is merge with them and become their, Toronto-based arm that helps them kind of grow in a way that's going to be really helpful for their potential. And maybe we could do everything you described. And I think it's really valuable just to get that idea of back-end opportunity. But then I started asking myself, well, could we be that company? Like, why do we need to join them? Is it smart to hitch our horse to their wagon or vice versa and grow? Or are we better off evaluating what is the right fit to grow into or to just kind of lean into our own opportunity? I'm not sure if there's a question that's clear in there, but hopefully
it sounds to me like the situation is what I call an acqui-hire. And what that means is, hey, I can't hire you. You own your own business. So the way I could access you and your clients and your skill is to acquire you so I can get your skill and your talent into my company because I believe that my company would be worth more if you're a part of it. So that sounds to me like that's where it's playing out. And maybe, Tom, there's components of your deal that are somewhat acqui-hire in its layout as well.
Yeah, I mean, my goal was to do less. So the idea of having, like I had to do it too. I learned sales, you learn this, and you're the jack of all trades doing so many things. And that took me away from doing all of those things as well as I could. And I think ultimately for me, my business suffered because of it. So like there's an energy component, there's a focus component that is worth considering. And what is it you want to be doing? Where's your time best spent?
Oh, I'm right there with that whole situation where yeah, and have been. I guess the one thing I wanted to jump in, Ben, sorry, I didn't even want to raise my hand and just going for it. So like say you're ready to start that process and you guys are talking about a 3 to 5 year kind of ramp up, I would suppose, to really make sure that you're getting your profitability up and making everything lean. What was your step and what was the thing that like was the first bit that you had to put into place to make sure that transition was going to happen and they actually made sense and had value for someone that want to buy?
You mean for like moving forward beyond this?
Yeah. So like, no, so like day one, you're like, I'm looking to sell or to what was day one of that process? Was it like 3 to 5 years out from a projection or was it much quicker? And you may have spoke to this already and I'm sorry if I missed it.
Yeah, I've been kicking around, opportunities for a couple of years and it just didn't land. It wasn't right. And then when this came along, it literally took 6 months from reconnecting to like getting it done and moving in. And it can happen quickly, but I think it couldn't have happened if I hadn't gone through three different processes of learning and understanding what wasn't right. And then one of the first things we aligned on is, okay, if we were going to do this, where does this go, right? And what does it mean? So one of the first parts that we talked about not only was, you know, our creative and, our peanut butter, your chocolate type of, conversation was like, okay, what does that make? And what, where, what do we do with what that makes, right? And so that was very early on, and we agreed on that very quickly. And so we were able to move into a 3-year plan almost immediately and just align everything. It made it so much easier because, so much of my business in my past is like, well, today we're this, right? 6 months from now, we could be that. A year from now, we're opening up a digital group or this. And now it's like, okay, we're doing all of this for one intention and one purpose. And that just made it so much clearer.
So
I
you
don't
didn't
know if that
really
answers your question,
position
but
yeah, yeah. You didn't really, I guess, the way I was framing it and looking at it is you didn't start positioning yourself. You found the right place. So you weren't coming at it from a different angle of repositioning the company or getting things more profitable, being more cognizant of budgets and whatnot. I suppose you were already there and you just
No,
attracted
no,
the.
I think Tom, I think you had the reality check of your valuation years prior because
yeah,
Okay,
your first conversation woke you up and you said, "Oh, that's what it is." So I
I
like to
see.
point out it's about 7 years to do an acquisition because the day you get acquired, there's a 3-year look back of your finances. So
Mhm.
there's 3 years of positive prep, plus the year of the dance from the time you meet somebody to finally being acquired. And then there's often a 2 or 3 year earnout to finally get the total amount that it's worth. They'll give you some cash up front or a piece of it up front, but you don't make your money until 2 or 3 years afterwards. So from end to end, there's a 7 year span. You probably only live 3 years of that 7 year span because you're stuck with your 3 years of the past and you can't influence it. But if you were to proactively deal it, you would have 3 amazing years, and then you would be really intentional to sell, regardless of how you feel. You would say, "I gotta sell now." It would have been awesome to sell in 2022. You know what I mean? Like the best year ever. Like you sell it in that year.
but like
2024 is harder.
Instead, I use my valuation to get divorced.
Yeah, exactly. That would be harder to do, right?
but
Like
it
half
doesn't
of
have
the
to
company's worth what? No.
Yeah,
it
yeah.
doesn't have to work that way either, right? Like so, you know, the valuation wasn't what I expected. It had been in the past, it wasn't now, and all of these things changed. I'm like, okay, so I own that. I bring that to the table, and then you do a creative structuring in which I can get as much value out of the company. I can create moments in which there is a cash infusion based on licensing this or ramping up my deal and putting it and forward. Like I think the traditional, like, oh, I'm buying you and it's going to be this factor and all that stuff. It's a good guideline, but it doesn't mean you have to play by those rules because I certainly didn't.
No. And creative businesses specifically, because they're so relational based, there's many, many hurdles that you've already overcome that other companies can't. They'll give you a chance to convert those and win in the back end for sure. But to some degree, you're still not done with that acquisition because your cash out hasn't come until after the current business exits at some point in the future. So your influence is still it's incentivized, but still wait to see to some degree. Yeah.
Well, the last years have sucked so badly for me that it's good to have day one be now, and I can look 3 years to even start having these
Yeah.
conversations.
Focus
Yeah,
on your profit margins more than your revenue. I could tell you that. That's where most
yeah.
people get it wrong. Your
Mm.
price per project is huge. So getting the price right, the services in the right order. So if you're using the factors method, the direct splits are super important. Lock those things down, let the rest of it flow. capture those profits. You have to capture those profits. If you let those go and call that reinvesting, you're in the early stage of a business, but in the exit stages, you don't invest in that client and those projects anymore. You hold on to it because that's your long-term investment, is cashing that out, 3 years from now. Yeah. I feel like I could start a small group just with the people on this call right now. So maybe I will. I'll follow up with all you guys to see if you want to do another core group like we did with Tom and his components and compadres in that space. I know it's super helpful when we did it with you guys. Tom, it is 3:03, so I'm 3 minutes after my extended time I promised you would be part of. But thank you so much for putting that out there for us and sharing your experience. Super helpful, very enlightening and educational as well.
I appreciate it. Thanks for having me.
Yeah, of course.
Good to meet everybody.
Thank you.
Good to see you all.
Bye.
All right, we'll see you guys all next week, and I'll follow up. Like I said, if you guys want to have more of this conversation, I'd love to facilitate it. In the meantime, have a great week. We'll see you next Wednesday.